A very good evening, friends. So I hope you are enjoying the good weather. Delhi, it's been a pretty cold weather today. But of course, the standard is not that cold. It is a very interesting standard indeed. So we have been talking in terms of consolidation standards, and we covered yesterday Ind AS 111. And today we've got another standard on consolidation, and that is Ind AS 28. Ind AS 28, the name of the standard is Investment in Associate and Joint Venture. In fact, if you remember, yesterday also we draw a reference that, when you're looking at a joint venture, the accounting as far as a joint venture is covered under Ind AS 28. So we can say that as far as Ind AS 28 is concerned, it not only addresses the accounting for investment in an associate, but also the accounting as far as a joint venture is concerned. So I think before I take this particular standard ahead, I think let me first of all work a little on the name of the standard, so that we get a little clarity in terms of the fact that when we're looking at, an associate or a joint venture, what exactly would trigger Ind AS 28. So let me, I think, first bring you to the name of the standard. And we're just going to work, first of all, a little on the name of the standard. So this is the unit number 6 of the study material. And as you can see on the unit number 6, we are given the name of the standard Ind AS 28. It says investments in associates and joint ventures. Now, we've already seen that what is a joint venture. When you establish a joint control by virtue of Ind AS 111, you may say that either it is a joint operation JO or it's a joint venture that is a JV. So we already know that a joint venture is a result of a joint control, but let's, I think, have a little insight in terms of associate before I give you clarifications. Well, if you look at the standard very clearly says that generally, the word is very clear, generally, if an investor has got 20 or more than 20, it means 20 also and more than 20 as well. So if the investor gets 20 or more than 20% voting power in the investee company becomes your associate company, because you would get what we call a significant influence. But having said that, let me also clarify, we've seen in terms of Ind AS 110, we've seen in terms of Ind AS 111 that nowhere a control assessment or a joint control assessment and even a significant influence is not a rule-based assessment. So it is not the percentage which will be a deciding criteria that if you say that we've got 20 or more than 20, it definitely implies a significant influence. The standard gives us clarifications that there is a possibility that you've got more than 20% voting power, but still there is no significant influence. And conversely, it can be true that you've got less than 20% voting power, but still you get a significant influence. But for the time being, let's assume that there is a significant influence when you get a 20 or more than 20% voting power, just to give you some clarification. So I'm coming back to the name of the standard, and let's first give you some basic inputs when Ind AS 28 would trigger. So I'm going to give you some permutation combinations, and if you want, you can start answering me as well, that whether Ind AS 28 would trigger or not. Once again, a very good evening, friends, to all of you. So get ready for some answers. So I'm going to give you some situations and you can decide. Let's consider a situation number 1, where I'm considering there is a company A Limited and I'm considering there is a company B Limited. And let's say company A is got, in terms of company B, let's say 20% voting rights. Now, in this particular case, if A gets a 20% voting power in terms of B, considering the rule-based concept, can I say B becomes an associate of A? So we can say that B becomes an associate company of A. And in this particular case, that 20% would mean that he gets a significant influence over B. So would A apply Ind AS 28? The answer is yes. So if I would consider whether Ind AS 28 would apply to A in this case, the answer undoubtedly is a yes. I think that's a plain vanilla case. Now let's take another case. Let's take a situation number 2, and let's take the same case where A, and let's say there is a company B. Now this time I am considering that A along with another investor, mind the words. Let's say A along with some other investor is got a joint control over B. So A cannot individually have a joint control. A along with some other investors is got a joint control over B. Then in this particular case, what would you do? This must have been decided by virtue of Ind AS 111. Here we would have applied the parameters of Ind AS 111 and decided that A has got a joint control over B. Then the next exercise is you would decide that B is either a joint operation or it is a joint venture. Because the moment you cover the concept of a joint control, you decide on the type of the arrangement and you would say it's either a joint operation or a joint venture. Now, if you say that B is supposed to be a joint operation, then A would apply in this particular case Ind AS 111. Then he would apply Ind AS 111, and this is going to be the case. Can I say whether he is going to make separate financials or he is going to make consolidated financials in this case? And I think it's also worth making a mention out here that Ind AS 28 is going to trigger for the consolidated financials of A. If you're looking in terms of separate financials of A, then it is Ind AS 27. Then it is Ind AS 27 which is going to trigger. So I think that's one thing we need to keep in mind, that A is going to prepare its separate financials based on 27 and a consolidated financials incorporating consolidating B as per Ind AS 28. So in this particular case, we can say A would apply Ind AS 111 for both separate and the consolidated financials. Now coming to the other one, if we classify B Limited as a joint venture, we again come back to Ind AS 28. But here again, let me caution that if you're looking at a separate financials of A, then he would apply Ind AS 27. And if you're looking at a consolidated financials, then he would apply Ind AS 28. So I hope I'm very clear on when the Ind AS will trigger. So I've given you two situations. One is a case. Let me focus very clear on that. So one is a case where A gets a significant influence and that would trigger an associate definitely. So as an investor, if you've got a significant influence over the company, then the investee becomes your associate. You apply 27 for separate and you apply consolidation 28. That's very clear. So you apply 27 for separate and 28 for consolidated financials. The other case which I gave you, if you say you get a joint control, but it should lead to the classification being a joint venture, not JO. So if you say that it's a joint control and it becomes a JV, the same status apply, 27 for separate and 28 for consolidated financial statements. I hope I'm pretty clear. The name of the standard is investment in associates, situation 1, investment in joint venture, that is situation 2. Well, I think if you want, I can give you another very interesting situation as well, which we covered yesterday, but I think I'll just like to connect it back. Because these are two very apparent situations, that there is a significant influence associate and there is a joint control JV, and that triggers Ind AS 28 for console. So if you want, let's, I think, remind you something. What do you say? Shall I do the honors? Okay, I think Uday's got a question. So can we say that Ind AS 111 gives only the principle to identify the JC and the JO? Yes, you can say that Ind AS 111 only tells you the parameters of identifying whether there is a joint control, and then if it is classified as a JV, you exit out of 111. And if you classify that as a JO, you still remain under 111. So the role of Ind AS 111 comes to an end the moment you say that it's a JV, you exit out of the standard and enter 28. But in a situation where you say that it is a JO, you are still within that particular standard, right? I guess that answers your question. Okay, so as I said, let's give you another third situation as well to give you a clarity of thought. So let's take another third situation, which we discussed yesterday as well. But I think I'll just like to still give you a quick recap of the situation when Ind AS 28 can trigger. Remember the situation we did yesterday that there are three parties A, B, C. And we said that, sorry, and we said A has got a 50% stake in the company. So let's say they created a company, A has got a 50%, B's got a 20%, and C has got a 20% stake in the company. Now, in this particular case, we can say that let's say A and B are supposed to be having a joint control. So they are having a joint control in this particular case, but he is a party to the joint arrangement. He's a party to the joint arrangement, but he does not have a joint control. Because in this particular case, when we identified that if you need a 75% majority to take a decision, A and B are having a joint control. C is a party to the arrangement, but he does not have a joint control. So I told you yesterday that you're going to make an assessment whether he's got a significant influence or not. And if you say, yes, he's got a significant influence, then the same treatment would apply. He would apply 27 for separate and 28 for consolidated financials. And if you say, no, he's not even got a significant influence, then in this particular case, it becomes a normal passive investment. And if it is a passive investment, then you would apply the financial instrument standard. And in this particular case, Ind AS 109 would apply. It's not going to be a case of either 27 or a case of 28. Trust me, these are the three kind of permutation combinations on a very apparent level, which will indicate when Ind AS 28 will trigger. So I'll put it in short, and I think you can easily vouch me. As an investor, you've got a significant influence over the investee. 28 is triggered for consolidation. As an investor, you get a joint control, but it gets classified as a JV, not a JO. You trigger 28 for consolidated financial. Number three, as an investor, you're party to the arrangement, but you don't have a joint control. You get a significant influence, and therefore, Ind AS 28 would trigger for the consolidated financials. I hope, friends, I am absolutely crystal clear when Ind AS 28 would trigger, right? Okay, let me see if any questions coming in so far. Okay, I think we've got some one or two questions. Can you give the other situation as well? Yes, Tariq, I think I've just given that situation. And Uday sir, is there no practical questions on Ind AS 111? Well, Ind AS 111, there has been, one very interesting question which is there. It's a combination of Ind AS 103 and Ind AS 111, which I remember came in the RTP. There's a question which is on blocks, where they're talking of some kind of a blocks have been taken over, some oil companies are there. Let's see if we get time, maybe we can do that question, I think, in the next class. But since we had a limited time of one class containing, Ind AS 111, I did not do that question. But we did a practical illustration, one small little question on JO, which is in the study material yesterday. And JVs will get covered out here. And then there is one question 103 plus Ind AS 111, which is pertaining to that block questions indeed. Yes, other than that, of course, we don't have any questions majorly on the concept of Ind AS 111 as such. Okay, now with this inputs, let's now discuss how am I going to go with this particular standard. Let me, I think, give you a little inputs in terms of how I will now approach this standard with you. Well, the first thing I'm going to do in this particular case is we are going to talk in terms of how do you assess a significant influence. Because we need to first of all learn the art of deciding that, if you're saying that you've got a significant influence over a company, how do you say that there is a significant influence? So assessment of significant influence is what we're going to learn. Second, well, once you decide that there is a significant influence, it would trigger a typical kind of consolidation technique, and that is called an equity method of consolidation. Ind AS 28 tells us that the consolidation technique which is going to be used is called equity method of consolidation. It is called equity method of consolidation. So this is a typical, you can say, style in terms of which consolidation is done. So we need to discuss how the equity method of consolidation is done. So we'll learn the practical aspects of consolidating using this particular technique. Now, in this particular case, there are certain exceptions. There are certain exceptions which we need to learn, in which case the equity method is not going to be applied. I think maybe before I discuss the equity method, though I'll give you a little flavor. So I think before we discuss the practicals on equity method, we'll rather discuss the exceptions, in which cases the company is told that you may or may not apply the concept of equity method of consolidation. And then comes another third area, and that is, as an investor, we may have, you can say, other long-term interest in the investee company. Because when you're looking at an associate relationship, you're looking in terms of that you've got equity shares in that company, a voting power in that company. But then there is an appendix to the Ind AS 28 which discusses that there is other long-term interest in the company. There is other long-term interest which the investor is got in the investee company. This discussion is a very specific discussion, and it is given in the appendix. It is given in the appendix to Ind AS 28. So we'll be discussing this more like a special issue. So we'll discuss this more like a special issue with you. But I think right now there are two major focus. I don't think so we'll be able to reach the third section today. We'll discuss the third section in the next class, because we'll do a little discussions on the leftover portions of 28, and we'll also discuss the aspects of 27 as well. Though 27 is a very small standard, so I think we'll spend a little major time in terms of 28, and we'll spend some time on Ind AS 27 in the next class. So I think let's start the journey in terms of how do you assess that there is a significant influence. So let me start with the first journey with you, and let's have a look at how do you decide a significant influence. Okay, now this is a little portion which I picked up from the standard, and let's see what does Ind AS 28 say on the concept of significant influence. So let me read some inputs. There is a definition given in the standard which says the significant influence is the power to participate in the financial and operating policy decisions of the investee, but it is not a control or a joint control of these policy. The definition nowhere gives you any percentage. You can see one thing very clear. The definition does not give you any percentage for that matter. It only says that a significant influence is the power to participate. The focus is only that you get the power to participate in the financial policy and the operating policy decision. But if you read further, the standard tells you something which is given below. And it says in para number 5, if an entity holds directly or indirectly. Now that is interesting. I'll take a little minute to explain this interesting point. It says if an entity holds directly or indirectly, example through subsidiaries. It says directly or indirectly. If it is indirectly, it has to be through subsidiaries only. 20% or more than 20% of the voting power, it is presumed that the entity has got a significant influence unless it can be clearly demonstrated that this is not the case. So there is a rebuttable presumption. If I were to put it in technical words, I would say there is a rebuttable presumption. When you say rebuttable presumption, it means something which can be challenged. So there is a presumption which can be challenged. It is called a rebuttable presumption. So the standard says if an entity holds directly or indirectly through a subsidy 20% or more voting power, it is presumed that you've got a significant influence. I think let's clarify one thing. Let's consider there is a company A which has got 20% in B. This is direct. This is direct. Let us consider there is a company A and B is got in C. Now let's say A is got a 60% in B, so B is a subsidiary, and B is got, let's say, 20% in C. The question rises, is C an associate of A or not? Yes, it is. Because A indirectly through a subsidiary. It says out here, if an entity indirectly through a subsidiary. So in this case, it directly has in B. In this case, it is indirectly through subsidiary. But what is important is that it is got indirectly only through a subsidiary. There is a very interesting case study based on this particular para, which is given in the education material. And I think I'd like to take you very soon to that particular illustration where we're given some very clear-cut clarifications that when it says through a subsidiary, so it means it has to be only through a subsidiary. It cannot be anything other than a subsidiary. So the indirect holding has to be rooted through a subsidiary. If this company is not a subsidiary, let's say it's an associate, or let's say it's a joint venture, I will not consider C to be an associate of A. I put it again. If in this particular case, let's say B is, let's say, an associate, or let's say B is supposed to be a joint venture, I will not consider that C is an associate of A. It is only if A, through a subsidiary, gets, a significant influence over C, then I would trigger Ind AS 28. We'll come to that case study as well. Then it says, conversely, if the entity holds directly or indirectly, example through subsidiary, less than 20%. So if it is less than 20%, then we presume there is no significant influence. So it says the voting power, it is presumed entity does not have a significant influence unless it can be clearly demonstrated otherwise. So the standard has made, a rebuttable presumption that if you've got 20% directly or 20% indirectly through a subsidiary, we presume a significant influence, but it can be challenged. If you've got less than 20% directly or less than 20% indirectly through a subsidiary, we presume there is no significant influence unless it can be proved otherwise. So there can be a significant influence below 20. There may not be a significant influence above 20 as well. Okay, so I think I am clear on the agenda. Okay, I guess we're getting some questions. Shruti sir, please take one more class so that we can solve the questions you are referring along with that NCA held for sale. Okay, I know, but that question NCA held for sale is nowhere given in the study material. That is something, which I said, is available. So let's see if we can manage question at least on Ind AS 111, what I think Uday also requested. And Shruti, you said, sir, why only a subsidiary is considered? Why not a JV or an associate? Now, that's a very interesting question. Well, technically, even if you refer Ind AS 24 for that matter, when you consider a significant influence, it is nowhere written clearly, but let me tell you, it's not considered to be a very strong kind of relationship. Control is always considered as a strong relationship. Even if you look at the definition which is given in para number 9 of Ind AS 24, I think the weightage which is being given to the control, sorry, which has been given to the control factor is, given more weightage. So when you control a company, it's more a strong relationship. But when you get a significant influence, it's considered a weak relationship. So if the thread of the relationship is based on, a concept of a significant influence, it is not considered. It is not considered. So maybe I think the reason of the standard setters not considering other than a subsidy is that the relationships are not as strong as the relationship of a control. That's what, I feel is the reason, because that's what Ind AS 24 is also based on. Okay, so let me now come to the agenda. I think, before I think we document, I think let's do a case study with you. Or I think we'll first make a small note, then we can go to the case study on this. So we can just give the heading significant influence. So I think we can just make some notes now. You can start writing as well. So we're looking at a significant influence. We're looking at a significant influence. So we can say, when you're looking at a significant influence, we can say, if there is a company A and there is a company B, and I think I like to put it like this, that if company A has in B 20% or more voting power, if company A is got in terms of company B 20% or voting power, I can say this means that it is got direct. This is directly held. So we can say 20% or more voting power, this is directly held, and we can say that it is presumed that A Limited has significant influence over B Limited. It is presumed that A Limited has got a significant influence over B Limited, but let us also put it can be challenged. It can be challenged. So it can be challenged, it can be demonstrated the other way around as well. One. Let's look at the other one. So let's consider the case that there is A, and let's say there is B, and let's say this is C. I'm just giving you some more appropriate notes because, when you go to revise at a later stage, it is very important that you get some concrete notes as well. Otherwise, discussions remains a discussion. So A is got a control over B and B is got a significant influence. So let's say A is got a control over B and B is got, let's say, a 20% or more voting power. So in this particular case, let's consider that B is got 20% or more voting power. So we can say in this particular case, we can say A has indirectly. So let's underline the word indirectly. So we can say that A is got indirectly. And since, you're going to get some MCQs in the exams as well, which is going to be 30% weightage on FR. I think it is very important to get that clarity as well, because, if you're able to crack those 30% MCQs well, you get a good score, a good base to pass the paper easily. So we can say that A has indirectly through subsidiary. So A is got indirectly through subsidiary. Let's underline the word through subsidiary. Rather, let me put a square. So we can say that A has indirectly, through subsidiary, significant influence over C Limited. And I think the same thing can be mentioned here as well, that in this particular case, it can be challenged. And I think to be on a very safe side, I would also like to make a mention that in this case, when I say through subsidiary, it cannot be, it cannot be joint venture or associate. It cannot be a joint venture or an associate. So in the given example, if B is an associate of A or B is under the joint control of A, then you cannot establish the significant influence of A over C. I repeat, if B, the middle company in the chain, is an associate or is it a joint venture, then you cannot establish the relationship between A and C. In order to establish the relationship between A and C, trust me, the middle company has to be a subsidiary only. Right, friends, I hope I am very clear on my thoughts. Okay, I think there's another question. Shruti said, sir, but sir, as you said, joint venture in consolidated financials, Ind AS 28 applies. So technically mention of a joint venture or associate should also be there along with the subsidiary, just linking. No. You see, the standard is addressing the accounting of an investment in an associate or accounting of an investment in a joint venture. Now, if A has got a joint control of B, which is a joint venture, I would definitely apply 28. But if it has got a further associate, A is not going to consolidate C in that case. Let me, I think, give a complete clarification. I think I'll just like to take it a little further, and I think let's clarify this very well. I think let me just give you the inputs on chain. I think just to give you a complete clarity, let's consider the concept of chain. Let's consider the concept of chain so that we're very clear, because direct is without a chain and indirect is with a chain. So I like to now give you a clarification. So let's say A is got in B and B is got in C. Let's say A is got in B and B is got in C. And let's say A is got in B and B is got in C. Now, I think let's give you a clarification. A controls B and B is got a significant influence. A is got a significant influence and B is got a significant influence. A is got a joint control resulting in a JV, and this is significant influence. I think now you'll get a complete clarity of thought. Let me throw light on this. We're doing a little more PhD in terms of the identification of that indirect word, but I think let's give you that clarity. Now, in this particular case, would A consolidate B? Yes. Would A consolidate C? Yes. Please mind it very carefully. Is A going to consolidate B? Yes, he is going to consolidate it as per Ind AS 110. Is A going to consolidate C? Yes, it is through a subsidiary. He's also got a significant influence, so he will consolidate as per 28. Now look at the next one. In this case, would A consolidate B? Yes, as per Ind AS 28. And would, in this particular case, A consolidate C? No. A has got no relationship with this company. I think even if you apply Ind AS 24, you'll get the inputs in this case. So A would only consolidate B. He is not going to consolidate C. Now, in this particular case, would A consolidate B? Yes. Since it's a joint venture, he would consolidate using Ind AS 28. But would he consolidate C? No. I hope I'm very clear on the picture that in this case, A will consolidate B and C both. Here he would consolidate B but not C. He would consolidate B but not C. So which means if there is a chain and in the middle of the chain, there is no subsidiary, If it is either a JV or if it is either an associate, the last chain A is not going to consolidate those bottom companies. Right? I hope I am quite clear on the picture now. Okay, wonderful indeed. That's great. Okay, so I think let's quickly consolidate the picture, what we have discussed. I think let's quickly consolidate the inputs to you. Then I think we could do a little interesting case study on that. So to remind you, we are focusing on the assessment of a significant influence. So you can see two situations. One is a direct holding and one is an indirect holding. So when it's a direct holding, it would not be a chain. And when it is an indirect holding, you'll see a chain. So you can see what I've done. If A has got a direct holding in B, 20 or more than 20, it is presumed that there is a significant influence and unless proven otherwise. If there is a chain where A has through B, which has to be a subsidiary only, then only he establishes a relationship with C. And in this particular case, we can say Ind AS 28 would trigger. So in the chain, what is important is the middle company needs to be a subsidiary. If it is other than a subsidiary, the relationship between A and C will not get established. That's the moral of the story. I think let's take you to a practical illustration. I've just added a few questions, picked up this from the education material as well. So let me just share a question to you. So there was a very interesting question which is there. So I guess let's have a look. Yes, that's the interesting question. So let's have a look at the illustration, the question number 8 on the screen. I think let me zoom it a bit further. I think yes, good to go. So let's look at the question number 8. This is a question which is there in the education material, and with the understanding which you've got, you should be able to give me an answer. I'm going to read the question and help me out with the answer. Though the heading says stake which is held by an associate and a JV of the group in another associate of a group. Now look at the structure. Entity X has got 100% investment in subsidiary A. So entity X has got 100% stake in A. So this is a subsidiary undoubtedly, which in turn has got 20% investment in associate Z. A has got a 20% stake in Z. Can we see that X is got indirectly in Z? You can see that X is got indirectly in terms of Z. I think that's very clear. You can easily see the picture that X company is got indirectly through a subsidiary. So do you establish a relationship between X and Z? Undoubtedly yes. Undoubtedly yes. Because what we said that X either directly or indirectly through a subsidiary. So this is indirectly, you can say through a subsidiary. So this is indirectly through a subsidiary. So relationship gets established. Let's read further. Then he says, in addition, entity X is also got 25% investment in B. X has got 25% in B, which is an associate. And he's got 50% investment in a joint venture C. He's got a 50% in the joint venture C, each of which has got 10% in Z. He's got 10% in Z. He's also got 10% in Z. I think you'll get the clarity now. Will you consider this indirect percentage, this indirect percentage? If you're holding it indirectly through an associate or you're holding it indirectly through a joint venture, would you consider that? The answer is no. The answer is no. That's what the clarification I gave you, that if it is indirectly, it has to be through subsidiary only. If it is through associate, no. If it is through JV, no. I guess this illustration will make it very clear. So what shall be the entity's X share in Z? X share in Z is going to be through the subsidiary, that is 20%. So we can say the answer is X has got 20% in terms of Z. And let me also give you a clarification further. X will consolidate A by 110. He would consolidate the associate by 28. He will consolidate B by 28. And he will consolidate C also by 28. I put it again. If you were to ask me which standards would trigger, X would apply Ind AS 110 for A, Ind AS 28 for Z with a 20%. He would take 28 on B and he would take 28 on C. He will not account for the stake which B has in Z or C has in terms of Z. I guess you would have got 100% clarity on that. Okay. So I'm given, Aditya tells me, sir, it is obtained through joint holding a middle company and each one is a subsidiary, other is an associate. That's right. So there are two middle companies, one is a subsidiary and other is also then what? I think you would have got your answer out here. That there is an indirect holding through subsidiary, yes. Indirect holding through associate, no. Indirect holding through JV, no. Right? I guess, friends, you would have got a complete answer. PhD done. Okay, clear? That's wonderful indeed. Okay, so that was a wonderful question. And I think let's go back. So I've given you the insights in terms of the significant influence. I've given you the insight in terms of the significant influence. Now, the significant influence is not done. It's not complete. You know, we are said that if you've got direct, indirect, 20% or more, it implies a certain influence and vice versa. So we need to understand when can you challenge that presumption. So what are the other factors which you need to consider where you would say that in spite of the fact that it is 20 or more, there is no significant influence? Or in spite of the fact that you've got below 20%, but still there is a significant influence. So the standard has given us some parameters which needs to be evaluated and seen whether significant influence is there or not. So let's have a look at the parameters which are given in this para number 6. So we'll take examples. There are a couple of examples given in the study material which illustrates these particular parameters as well. But let's, I think, read them first. It says the existence of a significant influence by an entity is usually evidenced by one or more of the following ways. Representation on the board of directors or equivalent governing body of the investee. So we should also see that as an investor, do you have a representation on the board of directors? Can you appoint the directors on the BOD? Then it says participation in the policy making process, including the participation in decisions about dividends or other distributions. As an investor, do I have the right to participate in the policy making decisions in terms of deciding, decisions regarding dividends? Material transactions between the entity and the investee. We need to see that between the investor and the investee, are there any kind of material transactions? Interchange of managerial personnel. So they are having, the key managerial personnels are being interchanged. And then it says provision of essential technical information. I think each of these clauses technically is quite self-explanatory, but we'll still run through some examples, illustrations, which are given in the study material. So it says the existence of a significant influence, you need to watch out these 5 factors, one or more of the factors. You need to see that as an investor, you've got a representation on the board of directors. As an investor, you can participate in the policy making process, typically the dividend decisions. Then, is there any essential technical information you're providing to the investee? Is there any interchange of managerial personnel between the two? And is there supposed to be material transactions between the investor and the investee? So if these facts might indicate that a significant influence is there or it is not there. So I don't think so I need to make a list of this. So the list is already there with you. We can maybe try some questions out. So I think I can try some questions. Let's first do some simple ones, and then we can go on to the other ones. So there are a few illustrations in the study mat where the application of these are given. So let me take you to the illustration number 2. One example each is given in the study on each of these clauses in para number 6. So let me, I think, read illustration number 2. I'll come to illustration 1 a little later. Let's have a look at illustration number 2. It says Cuckoo is got 12% voting rights in Boho. It's below 20%. So if I just look at the percentage, it seems there cannot be a significant influence because it is below 20. It says the Boho board comprises of 8 members and 2 of these are appointed by Cuckoo. So he's got a representation on the board of directors as well. Each board member has got 1 vote at the meeting. Is Boho an associate of Cuckoo? Now we've just seen that one of the parameters is that as an investor, do you have a representation on the board of director? Now in this case, the investor has got a representation. Out of 8, he can appoint 2 directors. Boho is an associate as significant influence is demonstrated by the presence of directors on the board and the relative voting rights at the meeting. So in this particular case, we can say along with a less than 20%, there is a representation on board of directors, so a significant influence can be demonstrated. Let's look at the illustration 3. It says M is got 10% voting power, below 20% again. The balance 90% is held by 9 other investors with 10% each. The decisions about relevant activities, except decisions about borrowings, are taken by the members holding majority voting power. The decisions about borrowings are required to be taken by the unanimous consent of all the investors. Further, decisions about taking borrowings are not the decisions that most significantly affect the returns of the investee. So it says determine whether M is got a significant influence over the investee. Now in this particular case, we can say your participation in the policy making process is there with a less than 20% voting power, but a participation in the policy making is there. So in this case, though M is holding less than 20, the M's consent is required to take decisions about borrowings, which is one of the relevant activities. Therefore, we can say it can be demonstrated that significant influence over the investee might be present. So the example is giving you an illustration, is giving you an example of each of the clauses of para 6. The previous illustration is giving you that there is a representation on the board of director. This illustration is giving you a reference that you've got a participation in the policy making process. So even though you've got less than 20% voting power, but coupled with the fact that there is a representation on the board or there is a participation in policy making, a significant influence could be indicated. Let's look at more examples of para number 6. So let's have a look at the illustration number 4. So let's see illustration 4, which is based on a third factor. It says RS is an entity engaged in the business of pharmaceutical. It invested in the share capital of XY with a 15% stake below 20. XY is engaged in the business of producing packing material, and one of the incentives of RS to invest in XY is that XY is engaged in the business of producing packing material, which is also useful for RS. Since last many years, almost 90% of the output is procured by RS. So they've got transactions with each other, and the transactions are material with each other. Since the transactions are material with each other, in spite of below 20%, a significant influence could be attributed. So 90% is definitely indicative it is material in nature. So 90% of the output is procured by RS. That would mean a dependency on RS for continuation of the business. So even though the holding is below 20%, significant influence could still be, attributed. Okay. Similarly, we're given illustration number 5. It says entity X and Y operate in the same industry but in different geographical region. X acquires a 10% shareholding in Y as a part of the strategic agreement. A new production process is a key to serve a fundamental change in the strategic direction of entity Y. The terms of the agreement provide for Y to start a new production process under the supervision of 2 managers from the entity X. These managers are seconded from entity X, one of whom is on the board of X. He will oversee the selection, recruitment of the new staff, the purchase of the new equipment, the training of the workforce, negotiation of the purchase contract. And the 2 managers will report directly to entity Y. Interchange of managerial personnel is what is indicated. So this interchange of managerial personnel along with a percentage which is below 20 could be indicative that there is a significant influence. I think each of these illustrations are pretty simple, only highlighting the example, representation on the board, material transactions with the investee, material, and then we're looking at interchange of managerial persons. So these are all examples of para number 6. I think let's also take one last example. There's another last example as well, which is illustration number 6. Then I think we'll consolidate the picture to you. Significant influence assessment will get taken care by that. It says R is a tire manufacturing entity. They entered into a technology transfer agreement with another entity. They entered into a technology transfer agreement with Y, which is also in the business of tire manufacturing. So they've entered into technology transfer, essential technical information. R is an established entity where Y is relatively new entity. As per the agreement, R granted Y a license to use that technical information and know-how. Y is dependent on the technical information and know-how supplied by R because he lacks the expertise and experience in the business, but he's got only a 10% stake. I think that again proves below 20% coupled with essential technical information would indicate a significant influence. So moral of the story, I think let's now consolidate the learnings at this stage. So moral of the story, what we have learned on the concept of significant influence. So on a very apparent level, if I were to evaluate a significant influence, what would I ask myself a question? Do you directly or indirectly through a subsidiary have a 20% or more voting power? Yes. You've got a significant influence unless you can prove it otherwise. Do you have directly or indirectly through a subsidiary below 20% voting power? Yes. You do not have a significant influence unless you prove it to me otherwise. So what are the parameters which you need to consider in order to decide that even if it is 20 plus, no significant influence, and if it is below 20, still a significant influence? 5 factors. The 5 factors are, is there any provision of essential technical information? Is there any interchange of managerial personnel? Is there any material transactions with each other? And we said, is there a representation on the board of directors? And the fifth one. So those 5 parameters in para number 6 will tell you, whether the percentage is below 20, still significant influence is present, or maybe above 20, but still it is not present. But we need to do a case now where it is sorry, where it is below above 20, but significant influence, let's say, is missing. So let's, I think, do interesting case study where as an investor, you've got more than 20 or more, but there is no significant influence. Sorry. And that is illustration number 1. So I think let's have a look at illustration 1. I think this is a good illustration I like, because in spite of more than a 20% stake, you'll see that there is no significant influence still. It says E has got a 25% voting power over the investee, so it is more than 20%. The balance 75% is held by 3 other investors with 25% each. I would like to also give you a clarification. If, let's say, one investor has got a control, can another investor get a significant influence? Why not? If, let's say, one investor has got a joint, two or more than 2 investors have got a joint control, can another investor get a significant influence? Why not? That means if there is one investor controlling the company, you can still have another investor having a significant influence. If 2 or more investors have a joint control of the company, you can still have another investor having a significant influence. So the presence of control by one, or the presence of a joint control by 2 or more than 2, does not preclude that you cannot get a significant influence over the investee. So if you're thinking that 3 investors have got 25%, each 75, and they get a joint control, that doesn't mean that this investor with a 25% cannot get a significant influence over the company. The decisions about financing and operating policies are taken by the investors holding majority voting rights. Since the other 3 investors hold majority voting rights, they generally take the decisions without taking the consent of E. The financing operating policies decisions are taken by majority, and these 3 people are in majority, so they take decisions without taking the consent of this fellow. Even if E proposes any changes to financing operating policies, the other 2 investors do not vote in favor of these changes. Poor fellow. He wants to take a decision, they take it without his consent. He proposes changes and they do not even listen to him. So in effect, the suggestions of E are not considered in taking decisions relating to financing and operating, whether E has got a significant influence over the investing. I always feel that this kind of a relationship is more like a paper relationship, where you've got 25% stake in the company and on papers, you've got a significant influence. But if you look at the commercial reality of the transaction, you can see that he doesn't have any kind of influence over the investee. He wants to participate, he's not allowed. He wants to suggest, he's not allowed. So this is more like, a paper significant influence. But if you look at the commercial reality, the things are indicating that there is no significant influence in this case. So in this case, even there is more than 20% of the voting power, we can say in this particular case, we cannot attribute a significant influence. Okay. There is one more thing which I like to clarify, but let me first consolidate the picture. So I am thinking I am thinking that, if I were to assess a significant influence, I can say in cases where there is less than 20% voting power, I should look at those five factors. And in those cases where I've got more than 20% voting power, I need to look at the commercial reality. What is coming as a conclusion to the mind is that the factors which are given in the para number 6 needs to be seen typically when you've got below 20% voting power. And I think if you've got more than 20%, you need to look at the commercial reality of the transaction. Like in this case, when you look at the reality of the transaction, it is indicative that you are a paper significant influence. What do you say? Am I thinking correct? So what do you think? Am I thinking correct? This is the crux in terms of significant influence assessment. Now, there is another one indeed. There is another one very interesting clarification which is given as an illustration on the study mat as well, and which is on the concept of potential voting rights. And I'd like to take you to that illustration as well. So there is a very interesting illustration on the potential voting rights which is given in the study material. I will like to take you to that illustration. Let's have a look at the illustration number 7. This is on potential voting rights, a very interesting illustration, and is going to give you a very interesting clarification as well. Then I think we'll quickly make a mind map on that and we'll go forward on that. Okay, that's rightly agreed. Let's have a look at illustration number 7. It says an entity is currently having 10% voting power of the entity, and he's got the option of purchasing additional 15%. So 10 plus 15 will make it 25. So you've got 10% actual and you've got 15% potential voting rights. However, the entity currently does not have the financial ability to purchase 15% voting power. Determine whether entity has got a significant influence. If you recall, in terms of Ind AS 110, when we were looking at the control assessment, we were looking at the potential voting rights as well. We said that today you've got less than 50% voting power, but coupled with the fact that your potential voting rights, you might go above 50. And we said the potential voting rights will certainly be taken in the control assessment. The same status is valid in terms of significant influence as well. That as an investor, you've got 10% and you've got 15% potential voting rights. And if you assess that, yes, you are definitely going to exercise these potential voting rights, I would definitely consider them as a part of the significant influence. But here the question is that there is a financial disability on the part of the investor that he would be able to buy these additional shares or not. Would that make a difference to my assessment that I may not be having enough funds to buy that 15% stake? There is a very interesting clarification which is given in this illustration. And that also compares us very well in terms of Ind AS 110. Watch this out, a very interesting illustration. It says, considering the potential voting rights, entity can have more than 20% voting power, and hence it is presumed that significant influence will be there. The fact that ability does not have the ability to purchase additional share is not considered in such assessment. But it should be noted that under Ind AS 110, potential voting rights which an entity cannot exercise because of the financial ability are not considered substantive and hence not factored in the assessment. However, under Ind AS 28, there is no such requirement given. Hence, potential voting rights, even if they're not substantive, are included in the assessment of a significant influence. In simple words, you've got potential voting rights, and I add on that you've got financial disability to buy those additional stake. In Ind AS 110, I will say no control. If you look at Ind AS 28, I would say there is a significant influence. I put it again. In both these standards, the potential voting rights are to be considered. Whether it is control or whether it is significant influence, the potential voting rights are to be considered. But if you're looking in terms of Ind AS 110, that is control, if the company is not in a position, the investor is not in a position to, in a financial ability to buy those additional shares, in those particular cases, I would say control is not present. Even though potential voting rights are there, but you cannot buy those additional shares, therefore the control is missing. But in terms of Ind AS 28, we don't factor that into account. Your ability or disability to buy those additional stake is irrelevant, and a significant influence will be established irrespective. Isn't that a beautiful clarification indeed? Okay, now I want to make a quick mind map on things. I'm done with the first area of discussion, and that is the concept of significant influence. Let's, I think, make a quick mind map at this stage. So let me do one thing. Let me just make a quick mind map on our discussions so far, so that everything is there at the back of the mind. So let's make a quick mind map summary on what we've learned on the concept of a significant influence. So let me make a quick mind map on this. You can note it down if you want. So there are a couple of things which are coming to my mind, and that is, when I'm looking at a significant influence, I would broadly consider that there are two kinds of questions. When I'm looking at the assessment, when I'm looking at the assessment of a significant influence, I would say there are broadly going to be two kinds of questions. One is, you've got 20% or more voting power. You've got 20% or more voting power. Or the other one is that you've got less than 20% voting power. You've got less than 20% voting power. So I would broadly divide it in two phases. You've got 20% or more, or it is less than 20. If it is 20% or more, one thing you need to be cautious on is it can be directly held or it can be indirectly held. But if it is indirectly held, you should immediately get the bell ringing that this indirectly held has to be through subsidiary only. It has to be through subsidiary company only. And we know it should not be through associate, it should not be through JV. We've done the question number 8. Okay, so when you say it is 20% or more, it can be direct, indirect, and in this particular case further. We can say it is presumed that significant influence is there. So this is the presumption that significant influence is there. But along with this, what do you need to see? You need to do a reality check. And this is what we've seen in the illustration number 1 of the study material. That you had a 20% more than voting power, but you do a reality check and you realize that in this case, significant influence is not present. Next. If it is less than 20% of the voting power, the same concept is there, directly or indirectly held. That is the same concept. But in this particular case, what do we say? It is presumed. We can say it is presumed that significant influence is not there. It is presumed that the significant influence is not there. And I would say in this particular case, what do you need to do? The significant influence could be there. So what are you going to do? You are going to look at the factors in para 6. You will look at the factors which are there in the para number 6, that representation on the board, the material transactions, the interchange of managerial personnel, provision of technical information. So I think that was running from illustration number 2, and I think it was 2, 3, 4, 5, 6. So you got illustration 2 to illustration 6. That maps up everything in a single chart. And there is another interesting clarification as well. There is another interesting clarification also to be kept in mind. So we need to consider another interesting clarification as well, and that is regarding the potential voting rights, PVR. So I'll put it as PVR, that is potential voting rights, to be considered. The potential voting rights are to be considered. But I think let's give you some more inputs at this stage. So we can say, in terms of the potential voting rights, if I say there is inability to buy, if there is inability to buy, and you're looking at Ind AS 28, we can say it is irrelevant. It doesn't make a difference to me. But if you're looking at the inability to buy, and you're looking in terms of assessment under Ind AS 110, then this becomes relevant in nature. We may not be able to establish control, but we may be able to establish a significant influence. And I think you can map this up as well. This was illustration number 7, where we did this agenda. I hope you like the summary. It summarizes all the 7 illustrations of the study material on the significant influence assessment based on all the permutations, combinations. Wow. Now, before we go forward, I guess I'm going to do the same little exercise. I want you to give me your comfort zone on a scale of 10 regarding your comfort zones on assessment of significant influence on whatever you've covered. So give me your comfort zones before we go to the next area of discussions. What is the comfort zone on the assessment of significant influence on a scale of 10? Let's see. Okay, so give me your comfort zones. In the meantime, let me go ahead. Now, as I started off with Ind AS 28, I said the first focus is going to be in terms of assessing a significant influence. And once you've assessed the significant influence, we're going to learn the technique of consolidation, and that is called the equity method of consolidation. Okay, I think that's a nice summary. Great. So we got a score 8, 8. That's wonderful indeed. I thought I'm going to get some more scores. We just got 2. Okay, so that was a summary in terms of the significant influence. Now, let's go to the next phase of discussion. We decided that once the significant influence is present, we need to apply a technique of consolidation, and that is called equity method. So let me do one thing. Let me first take you to a little insight on what is equity method before we come to those exceptions where, equity method cannot be applied. So I think let's start the journey. So I'm now going to take it to the next stage. We're looking at the equity method of consolidation. Now watch this carefully, because it's a very simple technique, but sometimes, we tend to go wrong in terms of equity method of consolidation. I will give you a very simple way of applying the equity method of consolidation with an example. But watch this very carefully. If you're able to get the grip, trust me, you would be able to solve any questions on equity method. Let's take an example to illustrate this. Let's say there is a company A Limited and it has got over B Limited, let's say a 25% voting power. So we can say B is supposed to be an associate. Let's say we establish a significant influence. Now, let's say the cost at which these shares are purchased is, let's say, to the tune of, let's say, 45 lakhs. So A acquired a 25% stake in B, let's say at a cost of 45 lakhs. The net assets of B Limited at a fair value on the date of acquisition is, let's say, to the extent of, let's consider 160 lakhs. So let's consider that the net assets of B at a fair value on the date of acquisition is 160. Doesn't it sound similar to Ind AS 103? Where you are going to compare the consideration versus the net assets on the date of acquisition at a fair value? Yes. Trust me, absolutely a similar exercise will be done. So what we're going to do at the first stage, the equity method of consolidation involves a stage number one. The equity method of consolidation requires a stage number one, identifying the goodwill or capital reserve on initial recognition. The stage number one is the initial recognition. The stage number one is the initial recognition. You're going to identify the goodwill or the capital reserve at the time of initial recognition of the investment. So I would say we paid 45 lakhs as a consideration, and out of the net assets of 160 lakhs, we get a 25% stake in B. So out of that 160 lakh, 25% belongs to the investor. So that comes to, I think, 40 lakhs. So we paid an excess of 5 lakh, and that excess can be called as a goodwill. So the procedure of identifying this goodwill or capital reserve is absolutely similar. You need to compare the consideration versus the share in the net assets at the fair value on the date of acquisition, and you get the goodwill. Now, let us say if I were to prepare a consolidated balance sheet of A, I'm saying if I were to prepare a consolidated balance sheet of A on the date of acquisition itself, I'm saying if I were to prepare a consolidated balance sheet of A on the date of acquisition itself, this investment would appear in the balance sheet at 45 lakhs itself. And in the inner column, you will give a disclosure that this is including a goodwill to the extent of 5 lakhs. This goodwill is not going to appear. This goodwill is not going to appear as a separate line item in the balance sheet. The goodwill identified in case of control becomes a separate line item in the balance sheet. But in this particular case, in Ind AS 28, this goodwill is a part of the carrying value of the investment itself. And you will only give a disclosure that this is including a goodwill of 5. So the goodwill identified is only disclosed in the inner column that this carrying amount includes goodwill. I hope I'm clear with the stage number one. So every time you acquire a significant influence over the company and you're looking at the equity method of application, you need to consider what is the goodwill or capital reserve and just make a disclosure in the inner column. That's it. Now, let's go further. After the stage number one comes the stage number two. After the stage number one comes the stage number two, which is, you can say, the post-acquisition changes. Which is going to be the post-acquisition changes. Now, that is the crucial accounting when you go to look at the post-acquisition changes. Now, let me explain how would the investor account for the post-acquisition change. It's going to be a very simple exercise. See how. Let's consider this is the investment which A made in B. This is the investment. One hand is the investment. And this is the net assets of B. So something like, you used to do a bank reconciliation. Trust me, I'm going to do something similar to make it simple. So let's say this is the investment which A made in B, and let's say this is supposed to be the net assets of B. Now, the golden rule which you need to remember, due to any post-acquisition movement, if the net assets goes up, I will increase the value of the investment. But the increase is to the extent of share in that increase. So let's say, for example, if I take 25%, let's say the associate company earned a profits. It earned a profit of, let's say, to the extent of 60 lakh. So when they earned a profit, the equity or the net assets increased by 60 lakh. I will also increase the investment, but to the extent of 25% of 60 lakh, there is 15 lakh. So the equity method will keep a track of the changes in the net assets or the changes in the equity. You need to see if the equity goes up, the investment goes up to the extent of share in the increase. If the equity goes down, the investment goes down to the extent of share in the decrease. So if the associate company earns a profits, equity goes up. Investment should go up by the share in the increase. If the associate company earns a loss, the equity goes down and the investment goes down to reflect the share in the decrease. So every time a transaction takes place in a post-acquisition period, every time the transaction takes place in a post-acquisition period, you need to consider the implication on the net assets. Net assets up, investments up by the share in the increase. Net assets down, investments down by the share in the decrease. But you would be more interested in the entries as well, that if there is an increase, investment up. But what is the corresponding credit? If there is a decrease, investments down, investments credit. What is the corresponding debit? Now that is another important golden rule. So, but first let's keep one thing in mind. In the post-acquisition, what you need to do, you need to track like this. You need to consider what is the movement in the associate net assets. You need to track the movement in the associate net assets. If the net asset goes up, you need to increase the investment to the extent of share in the increase. If the net assets goes down, you need to decrease the investment to the extent of share. So whenever any transaction will occur, sorry, whenever any transaction will occur, you need to capture, okay, this transaction leads to increase in net assets, investment up, share in the increase. Led to the decrease in the net assets, investment down to the extent of share in the decrease. So you need to continuously monitor the change in the net assets and continuously take the impact in terms of the investment. But another input what comes into mind is agreed that if the net assets of the associate goes up, in this particular case, you need to increase the investment to the extent of share, which means in the form of the entry, you will say investment account debit. And if there is a decrease in the net assets, you will say, let me decrease the investment by the share. So you will say, okay, let me give a credit to the investment. But the main issue which will come up in mind is, what is the corresponding credit? The main issue what comes to the mind is, what is the corresponding debit? Now I'm going to give you a golden rule for that as well, that what is going to be the corresponding debits and credits. Now watch this carefully. Watch this carefully. We'll do a couple of questions also to make it very clear, but watch this carefully. Now let's say the associate company earned a profit in the profit and loss section. The income statement comprises of two sections. One is the profit and loss, and one is the other comprehensive income. So let's say the associate company earned a profits in the P&L section. So net assets up, investments up. Where does the corresponding credit goes? He earned a profit in the P&L. He takes a credit in the P&L. With the same logic, let's say the associate company is earning a profit in the OCI section. They're earning a profit in the OCI section. So I would increase investments, and where will the corresponding credit go? OCI. So you mean to say that the post-acquisition movement could be in P&L, then you will take P&L, and if it is OCI, you will take OCI? Yes. Answer, if it is equity, that means it is directly taken to SOKI, that is equity. I'm going to take a direct credit to equity itself. So trust me, the corresponding credits and the corresponding debits will either be to the P&L, or either be to the OCI, or either be to the equity only. There cannot be a fourth item. Because when you're going to look at the transaction movements, you're going to see that any movements in the equity, if he earns a post-acquisition profits, P&L section, investment to P&L. So OCI section, investment to OCI. The investor needs to take the same credit which the investee took. I mind the words again. The investor will take the same credit or the same debit which the investee took. If the investor has got a credit in the P&L, the investor takes a credit in the P&L. If he takes a credit in the OCI, he takes a credit in the OCI. If he takes a credit in the equity, he takes a credit in the equity, and vice versa. So I think let's consider an example. Let us consider that as far as the associate is concerned, they made a revaluation of the PPE. So if they made a revaluation of the PPE, the net asset goes up. And what goes up correspondingly is OCI. Because when you do a revaluation under Ind AS 16, then OCI gets a credit. So what does he do? Investment account debit, and the corresponding credit goes to OCI. I hope, friends, you got the picture very clear. Conceptually, I hope you got the picture clear, right? Okay, let me still consolidate the movements once again before we track any questions on this. So let me put it like this. Once you apply the equity method of consolidation, you need to go in two stages as far as the equity method is concerned. Number one, you need to go in for stage one, that is called initial recognition. When you're considering the initial recognition, what do you need to do in this particular case? Just identify the goodwill or the capital reserve, as the case may be. Compare the purchase consideration paid versus the share in the net assets. But remember, the share in the net assets is going to be taken at a fair value on the date of acquisition. So you're going to organize the net assets at fair value on date of acquisition and compare it with the PC, get the goodwill or the bargain, the capital reserve, as the case might be. This goodwill is not going to appear as a separate line item in the balance sheet, but is only going to be a part of the disclosure in the inner column of the investment. So when you go to present a consolidated balance sheet, let's say on the date of acquisition, you're just going to give a disclosure that this investment includes this amount of goodwill or this amount of capital reserve, whatever the case might be. As simple as that. Then comes the post-acquisition movements, where you need to go with the golden rule that you need to consider a track. You need to track the changes in the net assets or equity of the associate. If the net asset goes up, you need to increase investment, but to the extent of share in the increase. If the net asset goes down, you need to bring down the investment to the extent of share. So increase increase investment, decrease in net assets, decrease investments. And the only thing to be kept in mind is the entry which is done. If the net assets goes up, see the corresponding credit went in the books of investee where? Did he credit the P&L? Investment to P&L. He credited the OCI? Investment to OCI. He credits the equity directly, investment to equity, that is SOKI directly. So whatever credit the investee gives, the same corresponding credit the investor will give for consolidation. So at the end of the day, the corresponding debits or credits will enter the P&L or the OCI or the equity only. So far, so good. I hope I am absolutely clear with the equity method as well. Right, friends? I don't think so. Any questions coming in so far? Let's try the questions now. We can maybe try some simple questions from the study material to begin with. So we can have a look at a simple question to begin with. Let's have a look at illustration number 8. So we get a little feel in terms of how the equity method of consolidation is applied. So let's have a look at illustration 8. Just apply the same concept which I gave you, that you need to track for the post-acquisition the movement of the net assets up and down, and you need to increase the investment up and down to the extent of share. Let's have a look. It says on the first day of the financial year, A invested in the equity share capital of B at a cost of 1 lakh to acquire 25% voting shares in B. So we're given that A gets a 25% voting power in B, so significant influence gets presumed. A has concluded that B is an associate of A. Now, I am not given the net assets on the date of acquisition. Since I'm not given the net assets on the date of acquisition, I cannot identify any goodwill or capital reserve. So the focus in this case is not on stage 1. The focus in this illustration is on the stage number 2. So let me, I think, clearly tell you that we are focusing on the stage number 2. We are focusing on the post-acquisition changes, because I'm not given any data to identify the goodwill or the capital reserve. So we're focusing only on post-acquisition movements. At the end of the year, the investment was made at the first day. At the end of the year, B earned a profit of 10,000 and other comprehensive income 2,000. They earned a profit of 10,000 in the P&L section. They earned a profit of 2,000 in the OCI section. In that year, it also declared a dividend to the extent of 4,000, past the entry in the books of A to account for the investment in associate. Now you can see very clear that when the associate company earned a profit, net asset goes up, investment to P&L. When it earned a profit in OCI, investment to OCI. See the inputs. So the initial entry to record the is simple: investment debit, bank credit. So this is a normal entry which you do in accounting, nothing great. But I could not identify any capital reserve or goodwill because of absence of the net assets data. Now it says recording the share in the profits of the associate. So can you see that there is a profit of 10,000 in the P&L section? So their profits means net assets up by 10. My share is 25%, 2,500. Can you see the entry? Investment debit, and the corresponding credit is given to the profit and loss account. Similarly, we can see that 2,000 is earned in the OCI. So out of that 2,000, 25% belongs to you. So 500 is the amount. So recording the share in the OCI, investment is debit and OCI gets a credit to the extent of 500. I think this would have made much clear that once the net asset goes up, due to P&L, so investment to P&L, due to OCI, investment to OCI. And then we are further given as far as dividends are concerned. So we are given further inputs as far as dividends are concerned. Now, once you look at the concept of dividends, we can clearly say if the associate company distributed a dividends, the net assets will go down. And if the net assets goes down, you need to bring down the investment to the extent of share in the dividends. So in this particular case, the entry. So in this particular case, we can see the entry recording of the dividend distributed. So what we have done, dividend distributed and the investment is given a credit 4,000 into 25%. Something interesting to watch out. In normal cases, when you look at accounting for dividends, the dividend received is always taken to the income statement P&L. But in terms of Ind AS 28, you will notice that when you receive a dividend from your associate company, you give a credit to the investment account. So that is something very interesting to watch, that in terms of normal accounting, the investment is always taken to the credit of P&L. But in terms of an Ind AS 27, the investment will get a reduction in the investment account. Because the moment the associate company pays a dividend, the net asset goes down. So you need to decrease the value of the investment to the extent of share in that dividend. So out of that 4,000, 25%, the credit takes place to the investment. I hope I am pretty clear on the application of the equity method. Stage 1, that is initial recognition, getting goodwill as a part of the carrying value. Stage 2, post-acquisition, where you track the movements in terms of the post-acquisition changes, increase net assets, increase investment, decrease net assets, decrease investment, corresponding debit credits, P&L, OCI, equity, as the case may be. Right, friends, I hope I am pretty clear on this agenda. Okay, there is a question, Kriti, you said, so in case of a significant influence indirectly, company will make a consolidated financials according to Ind AS 110. Well, indirectly, not for C, not for C. You see, if you're saying that, let's say there is a company A and there is a 60% stake in B and B has got a 20% stake in C. Let me again remind you that A is going to consolidate B under 110 and A is going to consolidate C under Ind AS 28. He is going to make a group financials. A will consolidate not only B, but also consolidate C. He's going to make a consolidated balance sheet. Well, B will be treated as a subsidiary consolidated under 110. C will be treated as an associate consolidated under 28. Right? I hope I'm very clear. In the indirect relationship, this doesn't mean C is not my subsidiary. C is ultimately my associate. So the consolidation will be based on 28 only. Okay, I hope that answers your question. Okay, so I think we can maybe now do some question with you, but there is one very interesting question as well. So we can maybe first, okay, do some simple question. Then I think maybe we can go to a tougher question. So let's have a look at one of a simple application of equity method. Then there is one very interesting question in the study mat, which is also there in the education material as well. We will come to that question later. But first, I think let's have a look at illustration 10. So let's have a look at illustration number 10 in the study material. I hope that is visibly good to see. Yes, clear, wonderful. Okay, so let's have a look now at illustration 10. It says Blue acquired 25% equity shares of Green on the first day of the financial year for 1,25,000. On that date, the carrying value of the net assets is 3 lakh and the fair value is 4 lakh. Let's, I think, read it till this stage only. Now I'm applying my stage number one, that is initial recognition. So let's work upon this. Let's work upon this. The workings are already done. This is stage one. This is stage one. So what is the cost of the investment? It is 125. Clearly given the cost of the investment 125. You need to take the share in the net assets at a fair value. So out of that 4 lakh, you've got a 25% share that comes to 1 lakh. So you compare the consideration paid versus the share in the net assets and you get this goodwill to the extent of 25. If I were to make a consolidated balance sheet on date of acquisition itself, what will be the carrying value of the investment? 125 itself. But in the inner column, I will reflect that this is including a goodwill to the extent of 25,000. So I will say that the investment is 125, including a goodwill to the extent of 25,000. That's it. Now let's read further. We'll have a look at the stage number 2. I would advise go stage by stage. You'll never go wrong. Because in stage number 1, you just need to get the goodwill and reflect it as a part of the carrying value. And then in stage number 2, you need to track the post-acquisition movements. Then he says the excess of the fair value over the carrying value is due to one of the buildings owned by Green, which has got a remaining life of 20 years. Now, there is something interesting to watch. When you took the net assets on the date of acquisition at a fair value, the difference between the fair value and the book value is attributed to an increase in the building. Now watch this carefully. When the associate company calculated the profits in his own books, he would have taken the depreciation based on the book value. So his profit computation is based on the profits which are there in the books, which is based on the book value of the assets. Now, when I'm going to apply the equity method, I need to consider the rectified profits. Which means I need to consider that there is a need to consider additional depreciation on that asset as well. So the profits which are given, Green earned a profit of 40. This 40 is after charging a depreciation on the book value and not on the fair value. So I will not consider the share in this 40. I will consider the share in the profits after additional depreciation. And it says other comprehensive income of 10,000. So they earned a profit of 40 in the P&L section. They earned a profit of 10 in the OCI section. Calculate the goodwill capital reserve. Done. Blue share in the profit and OCI and the closing balance of investment is to be taken. So the only new thing which you need to watch out. When the associate company earned a profit, you know the reported profits. I will not take the share in the reported profit. I need to get the share in the rectified profits. I need to get the share in the rectified profits in this case. So what I'm going to do, I will first of all convert this 40,000 into a rectified profits. So I will say out of this 40,000, let me reduce the additional depreciation. And then I will consider the share. The fair value of the asset was to the tune of 4 lakh and the book value was 3 lakh. So there is a difference to the extent of 1 lakh. And 1 lakh is going to be depreciated over the remaining life of the asset, which is 20 years. So if you're going to consider 1 lakh spread over the remaining life of 20 years, the additional depreciation is to the extent of 5,000. So when you consider the share in this particular profit, you will say 25% in the rectified profit. So out of 35,000, 25% belongs to the investor. That works out at 8750. So when you're going to pass an entry that is due to increase in the profits, investment debit and P&L credit 8750. And you can see this 8750 out here. And then out of that increase of 10,000, you take a 25% and you can see 25% out here. So if you look at the journal entries which are done in this case, you can say the entry is investment debit, P&L credit, share in rectified profits, post depreciation. And this is investment debit and OCI gets a credit that is 2,500. So we can say if you look at the total value of the investment, if you look at the total value of the investment at the end of the year, this was the value of the investment at the start of the year. You added 8750, you added 2,500. So this is the closing balance of the investment. No worries, we'll make some conclusions, document them as well. But I hope you've got the clarity in terms of application of the equity method. How do you pass entry? You just need to be careful. The value addition is profits earned, get the share in rectified profits. Because when you took the net assets at a fair value, there would be a need to consider additional depreciation out of that reported earnings and get the figures. Right, friends, I think so far so good. I think it's time to give you some break as well. And okay, I think Kriti says, could you explain the rectified profits once again? Okay, I'll put that once again. Let me just, I think, use a page. Let me, I think, illustrate this once again to you. You see, we need to understand one thing. This is investor and this is investee. This is investor and this is investee. Now, let's keep one thing in track. At the time of initial recognition, what he did, he said, I paid 125 and let me compare it with the net assets at a fair value into the share. This is net assets at fair value. This is net assets at a fair value. So he made a comparison that I paid this money and I get a share in the net assets at a fair value, and you got the figure of goodwill, that is 25,000. This is the calculation which he did as per Ind AS 28. Now, this investee company made a P&L and said we've earned a profits. And he says we've earned a profits, I think, to the extent of 40,000. And we've earned a profit to the extent of OCI, that is to the extent of 10,000. Now, what we need to appreciate in this particular case is this profit which is computed, is it after considering a depreciation based on a fair value or based on a book value? It is his books. He was making a comparison from the consolidation point of view, considering a fair value. But when he took this profit, it is after depreciation on book value, but not on a fair value. I hope I'm clear. So this figure of profit is, you're calculating the depreciation based on the book value of the assets. He would not have considered the fair value impact in his own financials. So his profit is after considering depreciation on a book value. Now, since he's already started considering a fair value, in this particular case, we need to be careful, and that is, he cannot take share in this profits. He's already considered the impact of the assets at a fair value. So what we need to do in this particular case, we need to translate this into a profit which is after depreciation. It is after depreciation based on a fair value. So since we've taken the fair value out here, we also need to get the profits after considering the impact of the depreciation on the fair value. Which means that this figure of 40,000 is after considering depreciation on 3 lakh. but we should have taken a depreciation based on 4 lakh. So since we did not take a depreciation on that additional 1 lakh, now you should take a depreciation based on remaining life and you get this rectified profits. So remember, when you're going to account for the post-acquisition changes, you cannot take a reported profits into account. The key is you cannot take the reported profits, you need to take the rectified profits into account. So when I consider the post-acquisition changes, I will say, let me take the profits which is after considering a depreciation based on a fair value approach, rectified earnings. And also let me consider out of the OCI section 25%, and that's how you get the value of the investment for concern. Right? I hope I am pretty clear on this picture. So the only thing to be seen is if on initial recognition, you take the impact of fair value, you cannot take the book profits into account. You need to get the rectified profits into account and then consider the share in the rectified profits. Right? I hope I am able to clarify the agenda. Right? I guess, Kriti, you got your answer better on that? Okay, that's wonderful indeed. Okay, I think it's good time now to give you a break. My mind must be a bit tired as well. So I think it's time to give you a break. So I think let's give you a 10, 12 minutes break, relax your mind so that we can do some more questions on this area because I'm yet to discuss the concept of exceptions relating to the concept of Ind AS 28. But that's later. First, we'll do some questions post the break. So let's first give you a break. Enjoy your break. I'm going to join you in another 10 to 12 minutes time. Welcome back, friends. I hope you relax your mind. And I think before we do another question on equity method, let's, I think, take first a quick recap and document some notes to you on the equity method of consolidation. And then we'll do a little more comprehensive question with you on the application. Okay, so I think let's first do a little summary view of this so that you have clear-cut things in your mind. So I'm creating a little second mind map as far as equity method is concerned. So let's create a simple mind map, because there are certain key considerations which you need to keep in mind when you're applying the equity method of consolidation. So this is the mind map as far as equity method of consolidation is concerned. So let's get the focus points very clear that when you're looking at the equity method, always go with a two-stage model. You got to go for the initial recognition and the post-acquisition changes. So at the stage number one, this is relating to initial recognition. The stage number one is relating to initial recognition. You got to compare the cost of the investment versus the share in the net asset. So we got to compare the cost of the investment, and this cost of the investment is going to be compared with the share in net assets. And there are two focus points that when you're considering the share in the net assets, you need to consider number one at a fair value and number two on date of acquisition. So let's get the focus points very clear that you need to consider the net assets at a fair value on the date of acquisition. So when you compare the two, and if you get an excess, there is an excess which is coming, and that excess is going to be called as a goodwill. Now, when you would consider this goodwill is not shown as a separate line item. This goodwill is not shown as a separate line item. So we're not going to show this as a separate line item in the consolidated balance sheet, but it's a part of the carrying amount. It is reflected as a part of the carrying amount of investment. So we can say disclosed in brackets. It is disclosed in the brackets. So you're going to show only a disclosure of the goodwill in the brackets. So these are the key aspects when you go to the stage number one. Next. Now, when you go to the stage number two, the stage number two in terms of accounting is supposed to be post-acquisition changes. And I think I'd like to present it a little different manner. I'd like to give you the journal entries to get the track. So we can say there could be, we need to basically track the movement of net assets, or you can say the equity post acquisition. So you'll have to make a track of the movement of the net assets or equity, whether it's going up or down. So we can take a couple of transactions, like for example, there is increase in net assets due to profits earned. So there is an increase in the net assets due to the profits earned. Now, when you consider that there is increase in the equity or net assets due to profit earned, we need to see that this profit earned could be on account of the profit and loss section, or it could be on account of the OCI section. So what you need to be careful on is that if it is due to the profit and loss section, you need to get the rectified profits. So what we'll do, first of all, we will get rectified profits. We will get the rectified profits. Underline the word rectified profits, which is reported profits, which is going to be the reported profits minus the additional depreciation due to fair value adjustments. So remember, when you go to consider the profit and loss section, you need to get the rectified profits, the reported profits minus the additional depreciation because of the fair value adjustments. And then the entry which you're going to pass is investment gets a debit, profit and loss gets a credit, which is to the extent of share in that rectified profits. But if it is supposed to be OCI, then it's not a problem. You will simply put the entry investment account debit and the OCI gets a credit. And this is again to the extent of share in that other comprehensive income. So I think that maps up the entire learning as far as the equity method is concerned. Now, I want to do two illustrations with you at this stage. One is where we can see the application where a credit goes to equity directly. And second, I want to see a comprehensive illustration which has got more agendas to watch. Okay, so far so good. I hope you've got a good hang on the equity method. Let's see if any questions are there. No, it's all clear. Great. So I think let's now begin with some illustrations back with you. So let me go back to the study material and we can watch out some more examples. Illustration 12 is definitely an interesting illustration. So why not do the illustration 12 first? This is a beautiful illustration. It is there in the education material also on Ind AS 28 issued by the Institute of Chartered Accountants. It's a wonderful illustration indeed. And this will also connect you to your understanding in terms of Ind AS 110. Watch this very carefully. So let me go to the illustration number 12 in the study material. I'll explain as I read the illustration to you. But watch this very carefully. Some of you might find this illustration a bit heavy and technical, but it's a very easy illustration. You just need to get your concepts, what you've done in Ind AS 110. Let's read. It says entity A has got a 20% equity interest in B as an associate. That in turn is got 100% equity interest in C. I think let's get the chain. Let's understand the chain as well. So he's telling me in this particular question that there is a company A which has got in company B a 20% equity interest. So B is an associate of company A. And then it says this company B in turn has got investment in C which is 100%. So C is supposed to be a subsidiary. Now, in any case, if you're thinking that A is going to consolidate B and C, of course not. Because in this particular case, we can say that A has got an associate relationship with B, then B is just a subsidiary of C. Okay. Then further, this is the initial inputs given. It says entity B recognize the net assets relating to C 1,000 in the consolidated financials. Now, B would have consolidated the entity C and he would have consolidated the things based on Ind AS 110 because he has got this company as a subsidiary. So he would have done a full consolidation. At this stage, I would also like to tell you something very interesting. Because you've done consolidation under 110, consolidation under 111, and you're looking at consolidation under Ind AS 28. So let's have a look at, the differences in which the consolidation is taking place. When you do a consolidation under Ind AS 110, you are doing a full consolidation. Why do we say it's a full consolidation? Because you would aggregate all the assets and liability irrespective there is an NCI or not. When we were doing Ind AS 110, we said consolidation is always full. So which means even if you've got 80%, 100%, you would aggregate all the assets and liability. It is called a full consolidation. Now, when it came to Ind AS 111 and it was a case of a joint operation, in those particular cases, we said, we can still use the word proportionate consolidation, though it's not technically right to say that it is a proportionate consolidation, but then you are considering your share in the assets, your share in the liabilities. So basically, you're doing something what we can call it for understanding as a proportionate consolidation. So there is a full consolidation in terms of control. There is a proportionate consolidation when it is a joint control JO. Now, if you come to Ind AS 28, the consolidation, which is equity method, is technically called a one-line consolidation. It is called a one-line consolidation because what you're doing in the balance sheet, you're only reflecting the investment. And trust me, I'll prove it to you in a short while as well, that investment as per equity method is going to appear at a share in the net assets at any given point of time, plus goodwill. Because if you're tracking the net assets of the associate and you're going to show the investment at a share in that net assets, trust me, at any point of time, you want to track the investment, you can say that it would be appearing at a share in the net assets plus goodwill. So, sorry. So it is technically called a one-line consolidation. So 110 is a full consolidation and 111 is something like proportionate, and Ind AS 28 is like one line consolidation. And I think it makes sense. If you ask me, different kind of relationship would lead to different kind of consolidation techniques as well. So coming back to the position, it says entity B recognized the net assets of C 1000 in the consolidated financials. Now entity B sells 20% of the interest in C to a third party, that is NCI. Now you need to watch out something interesting, that when B sells 20% stake in C, he's still left with 80%. If you remember, the last area of discussions we did in Ind AS 110, we said if you make a disposal and the control continues, in this particular case, you remember we said the entry is going to be bank debit and NCI credit. Because if the control is lost, you do the reversal entry of 103. But in this case, the control is not lost. So what do you need to do in this particular case? You are going to put the entry on disposal, that is bank account debit, and the NCI will get a credit. So because it is a situation where a disposal results in a control being continued, so it is a transaction between the equity shareholders, the majority and the NCI. So you put the entry bank debit, NCI credit. So if I come back to the question, it says further, so entity B sells 20%, that is for 300, and recognizes this as an equity transaction in accordance with para number 23 of 110, which means he is making a reference to this entry which you did. It says resulting in a credit of equity to the extent of 100. Now, if I just come back to the entry, it says if you sold this investment at 300, and the NCI is going to be recorded at a share in the net assets. So since the net assets of C is 1000 and you are selling 20%, so NCI gets a 20% stake in that net assets. So if you remember, the balancing figure in this entry is going to be given a direct credit to equity, that is okay. So we decided in terms of Ind AS 110 that once a company disposes of a partial investment, but the control continues, you put this entry and the profit or loss on this transaction is directly taken in terms of equity. Now, what's the implication? If B took a credit to equity, please mind this carefully. If B took a credit to equity, naturally his net assets have increased to the extent of 100, and this increase is taken where? This increase is taken directly to equity. So as an investor, when A would account for that increase in 100, that is 20% of that, he should be giving a credit where? He should be giving a credit to equity. because I made it very clear that you need to track the movements in such a way that if the investee credits P&L, investor credits P&L. Investee credits OCI, investor credits OCI. Investee credits equity, the investor would credit equity. Let's read further. Then he adds on in the question. He says the financial statements of A and B are given as under. So he's given you the financials of A and B before consolidation for better understanding. You can see in the balance sheet of A, that is the main investor company, he's got investments in B and he's got equity 200, simple. If you look at the consolidated financials of B, in this particular case, in the consolidated financials, there are net assets of C and is represented equity 1,000. This is before the disposal of 20% stake by B. Let's take it further. Now it gives us further. So let's have a movement further. So we're given the further movements after the disposal. Now he gives you these situations which is after disposal, and see, this is the balance sheet of B. Now see what is happening. You can see the equity turning out to be 1100 because there is a profit on that transaction. Bank got a debit 300, NCI gets a credit 200, and the equity gets a credit of 100. So you can see the NCI coming in and you can see the equity increasing and the cash balance coming in. So incorporating the entry bank debit 300 and NCI credit 200 and the equity gets a credit 200. So they've incorporated that transaction. It says although A did not participate in the transaction, A's share of net asset in B increased as a result of sale of B in C. So in this particular case, you can say that, when B disposed of a 20% stake in the subsidiary, because of the disposal, the net assets of B increased by 100. Because of the disposal of the net assets in the subsidiary, his net assets increases by 100, which is by a credit to equity. Should A also record the 20% in that 100 and give a credit to equity? Yes. It says A share in the net assets is now going to be 20% of 1100 as compared to 20% of 1000 earlier. So there is a 20 increase, 100 into 20% directly. How is an equity transaction recognized in the financial statements of the associate reflected in the consolidated financials of A that uses an equity method to account for it? It's a wonderful illustration trying to tell you the moral of the story is that if the investee credits equity, investor would also put the entry investment debit equity credit for sure. So it says the answer, I'm just putting the last part, in the given case, entity A recognizes 20 as a change in other equity instead of P&L. And C maintains the same classification, as the associate, a direct credit to equity in its consolidated financials. I think it's a beautiful illustration indeed. This illustration, sums up the conclusion that when the investor is going to put the entry investment debit, for sure, the corresponding credit will be P&L, OCI, or equity. If he puts the entry investment credit, the corresponding debit is going to be undoubtedly, you can say P&L, OCI, equity for sure. I hope, friends, I am very, very clear with this particular question. There was a little technical one indeed, but I guess that makes things very clear. And before I go further, I want to prove another point which I said. And I said a little while back that as per equity method, you can do certain cross checks and you can see that the net assets, the investment stands equal to a certain figure. I think, let me prove my point with a simple example further. So let me take an example and give you, and make your life simple, because if you're able to do this cross check, trust me, it's going to be very, very easy indeed. So let's take an example to prove my point. Let's take a very simple example and then we'll try to visualize, and I'm going to give you something journal. Try this on any questions. Believe me, it's going to work. Let's say there is a company A Limited and it gets a, let's say, 25% stake in B. And let's consider the cost of this investment is equal to, let's say, 50 lakhs. And let's say the net assets at fair value on date of acquisition of B is, let's say, to the extent of, let's consider 180 lakhs. So I'm taking a simple example. So let's say the cost is 50. A got the investment in B at 50, and the net assets of B on date of acquisition at fair value is 180. So let me first work out the stage one. I guess if I work out the stage one, you can compare the cost of acquisition 50 lakhs and compare this with the share in the net assets. 180 into 25% is 45 lakhs. So you will get 5 lakhs as goodwill. Now, friends, watch me carefully and vouch me carefully on this. Let's say if I were to make a balance sheet, a consolidated balance sheet on this date itself. If I were to make a consolidated balance sheet, let's say on this date itself, I would reflect the investment on the date of acquisition at 50 lakhs itself, reflecting a goodwill to the extent of 5 lakhs in the inner column. I would say that the investment is 50 and there is a goodwill which is included to the extent of 5. Now I'm going to say something, please vouch me carefully. Is this investment appearing at share in net assets plus goodwill? A similar thing I said in Ind AS 110 as well. Please vouch me. A similar thing I said in Ind AS 110. Can I say your investment is appearing at the share in the net assets 45 and the amount of goodwill that is 5? Let me see if you've been able to vouch me on this or not. So can I say if I want to look at the investment is appearing at share in the net assets plus goodwill. If you recall, in terms of Ind AS 110, I gave you the same input and I said that investment is replaced by the net assets plus the goodwill minus the NCI, which is indirectly the net asset share plus the goodwill. Do you vouch me for that? Do you vouch me for that investment is appearing at the share in the net assets plus the goodwill on the date of acquisition? Right? I guess I didn't get a single yes on that. I guess you vouch me on that. So agreed that this is appearing at a share in the net assets plus the goodwill amount. Okay, now let's go to the stage 2. Now let's go to the stage 2 and let's consider the post-acquisition changes. Let's consider the post-acquisition changes and we'll just take only one transaction to prove the point in this case. Now let's consider that the associate company earned a profit in the post-acquisition period in the P&L section. So let's say there is a profit earned, and if the profit earned is, let's say, to the tune of, let's say, 60 lakhs. And this profit earned is, let's say, earned in the profit and loss section itself. So what do you say in this particular case? The net assets of the associate went up, and so would the investment go up. So you would put the entry that is investment account debit, and the corresponding credit goes in the P&L, and you record 60 into 25% share, that is 15. You're going to record a 25% stake in that, and that comes to 15 lakhs. Now, let's understand if I were to make if I were to make a consolidated balance sheet, let's say at the end of the year. Let's say if I were to make a consolidated balance sheet at the year end, let's consider what is the value at which investments would appear. Can I say investments would now be appearing at what? 50 plus another 15, that makes it a total of 65 lakhs. And of course, you'll make a mention that this is including a goodwill of 5. So my investment is now appearing at 50 plus 15, that is 65. And I want to again make a cross check and vouch it. Can I say what is the net assets of the associate? It was 180 lakhs. It was 180 lakhs and they earned another 60 lakh. If you look at this carefully, they had a net assets of 180 and another 60. The total net assets of the company is standing at 240. So if you calculate out of the 240, what is the share in the net assets? That is 25%. And to this you add the goodwill. See, is it equal to 65? Yes, it is. 240 into 25% is 60. 60 plus another 5, that makes it 65. Let me make a very strong statement. And if you can vouch me, that's good. So let me make a very strong statement and let's get your vouching on that. If you're able to vouch me, then I think you've got the concept. Can I say at any point of time, mind the words, at any given point of time, investment in the consolidated balance sheet will always be equal to share in net assets on that date plus goodwill? I repeat. I'm saying if you compare, you want to look at the value of investment in the consolidated balance sheet. Sorry. I will say, okay, let me do one thing. Let me see what is the net assets on that date. Let me calculate the net assets of the associate on that date into your share plus the goodwill, and you will be able to get what is the carrying value of the investment. So we can say, as per the equity method, investment will always stand equal to the share in the net assets on that date plus the goodwill. What do you say? Do you agree with this statement? Okay, I think I'm not getting some messages now. Maybe I think there's too much inflows of messages, but I think what I said is absolutely correct. So I think let me put down the moral of the story out here. So we can say that as per the equity method, we can definitely say, okay, I think I got the answer. Not in case of OCI and equity. Not in case of OCI equity. No. Whether the profit is earned in the P&L or OCI, that would not make a difference. At the end of the day, if the net assets is at a certain figure, the investments will always stand at the share in the net assets on that date plus a goodwill, for sure. 100% guarantee. You can try this out. You can see in this example and otherwise. So we can say, as per equity method, investment will always be equal to the investment will always be equal to share in net assets. Share in net assets on that date. Share in net assets on that date plus goodwill. Try this out. You will always get the correct answer. You can see that the investment will be equal to the share in the net assets plus the amount of goodwill. Okay. So that was, I think, a good analysis. We should now do a little comprehensive question on the equity method as well. So let me share a question with you. I've just added a few questions separately as well. So maybe we can try another question with you. And let's have a look at this. So let me, I think, bring you to a little comprehensive question. So we've got two questions out here, but we can try maybe one and maybe we can give you the other one as homework. There is one question which is January 21 examination question. And there is another question which is came in RTP in November 2020. So I think I'd like to try the question number 4 with you, which is a very interesting question indeed. So let's apply this equity method and that would consolidate the entire learnings before we take it further. So let me read the question number 4, which is RTP November 2020. It says on 1st April 19, investor acquired a 35% interest in another entity, makes it an associate. It says XYZ Investor Limited determines that it is able to exercise a significant influence. So Ind AS 28 gets triggered. Investor is paid a total consideration of 4750 for the acquisition of interest. And at the date of acquisition, the book value, it says the book value of the net assets is 90 and the fair value is supposed to be 110 lakhs. I think let's concentrate till this end. You know, the moment you see that there is a difference in the book value and the fair value, you need to be careful. It gives rise to additional depreciation. So when you go to consider the post-acquisition gain profits, you need to convert the reported profits into rectified profits after considering additional depreciation as well. That should immediately click to your minds. So let's, I think at this stage, try the stage number 1. Let's, I think, first try the stage number 1. At this stage, let's see the goodwill or the capital reserve. So we can see that the cost of this investment, we acquired this at a consideration of 47.5 lakhs. And let us see what is the share in the net assets at a fair value. So we given the net assets at a fair value is 110 lakhs. So out of that 110 lakh, 35% belongs to the investor, that is 38.5 lakhs. So we can get the difference, and the difference works out at 9 lakh, and that is supposed to be goodwill identified on initial recognition. Comparing the consideration paid versus the share in the net assets at a fair value, we get the goodwill. So investment at this stage would appear at 47.5, and that is including a goodwill in the inner column of the balance sheet. Let's read further. Investor determined that the difference of 20 lakhs pertaining to item of PPE, which has got a remaining life of 10 years. So I think we can consider that we need to also consider additional depreciation, and that additional depreciation is going to be 2 lakhs per annum. 20 lakhs spread over the remaining life of 10 years, we get 2 lakhs depreciation. Then he says, during the year, the company made a profit, and that is a book profit based on depreciation at book value. And they paid a dividend, which is 12 lakh on 31st March. Then he says XYZ also holds a long-term investment in equity security, and under Ind AS, this investment is classified as fair value through other comprehensive income in accordance with 109. And XYZ recognized increase in the value of investments in the OCI section of the P&L. Ignore any deferred tax implications. Calculate the closing balance of the investor's investment. Now we can see there is a profit in the P&L section, which is reported to be required to be converted to rectified, and there is also an amount of profit in the OCI section as well. So let's do one thing. Let's go to the stage number 2. Let's go to the stage number 2, and first what we'll do, we will convert the reported profits. We will convert the reported profits into the rectified profits by reducing the additional depreciation, because we will not be able to pass the entry unless we rectify the profits, reduce the additional depreciation out of it. So we are given that the profit earned is to the extent of 8 lakhs. And the additional depreciation we've just identified is 2 lakh. So we can say the rectified profit is to the extent of 6 lakh. So we can now put the entry investment gets a debit and the profit and loss gets a credit. We will consider 6 lakh into 35% stake. So if you consider 6 lakh into 35%, that works out at 2.1 lakh. And then he further gives me that 2 lakh is taken in the OCI. So investment gets a debit and the OCI gets a credit. And in this case, out of the 2 lakh, 35% belongs to the investor. So this entry will be done at 70,000. So now if I need to calculate the value of the investment at the end of the year, we acquired the investment at 4750. So 47.5 plus another 2.1 plus another 0.7. So we can say the carrying value of the investment at the year end is appearing to the extent of 50.3 lakhs. So if I were to calculate the value of the investment at the end, 47.5 is the value at the start, plus the share in the P&L section, plus the share in the OCI section, and you get the carrying value of the investment as per the equity method. That works out at 50.3. Right, friends, I think that was a comprehensive question, and I think that should have clarified the equity method as well. So we're done with 2 sections, but the second section is slightly pending. I have given you the concept of significant influence assessment, done. I've given you the equity method application, done. Now we need to discuss something which will not get completed, but it would be a little pending, but I want to start the triggering things. So before that, let me see any questions on your mind. Okay, nothing so far, all good. That must have been very technical indeed. Since we are trying to cover maximum things, naturally, you will get a little overflow of data as well, that there are a lot of things to be remembered in terms of the standard. Okay, now I am coming back to another area of discussions. Now, this area relates to the equity method only. But in this particular case, I want to now take you to certain areas where there are certain exemptions in the standard. We will not be able to finish this section, but at least we'll trigger off the thoughts. But don't worry, the notes will be given to you, because there has been a very interesting question in the RTP. On this particular area, I remember there was a question in the RTP where there are 3 different situations given, and it's a very interesting question. And unless you have done and read the relevant portions, you cannot attempt that question. It came long back in terms of RTP. I'm already carrying that question as well. But let's, I think, first begin. Let's first read something. Let me, I think, zoom it a bit further. I need this para number 17 and 18 and para number 19. Okay, now read it carefully with me. What we are now discussing is going to be a bit technical after so many discussions, but don't get worried. We will consolidate the learnings, what we're going to do in the next 10-15 minutes in the next class as well. So don't get worried. It talks about the exemptions. It talks about the exemptions from applying. If you remember, when I gave you Ind AS 110, we were talking in terms of exemptions and exceptions. And if you remember clearly, I told you very clearly that exemption is a matter of choice and exceptions is a matter of mandate. So when it clearly says exemption, it says an entity need not apply. So it is not mandatory. It is something where you are getting an option. So even if you meet the parameters of para number 17, you've still got a choice to apply equity method. The standard is giving us the circumstances where the investor is getting a choice. He wants to apply equity, he can. He doesn't want to apply equity, he may not. It says an entity need not apply the equity method to an investment in an associate or a JV if the entity is a parent that is exempt from preparing consolidated financial statements by the scope exception in para number 4A of Ind AS 110, or if all the conditions apply. I think let's make your life simple. If you recall what we did in terms of Ind AS 110, I gave you the concept of para number 4A, where there were a total of 4 conditions, and we said if the 4 conditions are met, and that is in a chain, and that is in a chain holding, I said you are given a choice whether to consolidate or not. Let me remind you, when we were doing Ind AS 110, we looked at the para number 4A and we said the para number 4A applies only when there is a chain holding, and it applies only to the middle company. So the 4 conditions was that in this case, if B is a wholly owned subsidiary of A, or if B is a partly owned subsidiary of A and the NCI doesn't object, if B is not listed, if B is not in the process of listing, and the ultimate parent or intermediate parent is presenting consolidated financials as per Ind AS for public use, we were giving an choice to B that you may not consolidate C. So this was what we learned in the para number 4A of Ind AS 110. Now see what he's telling me in terms of Ind AS 28. It says an entity need not apply equity method to investment in an associate or JV if the entity is a parent. Now let's say B also has an investment in D. Now let's say B also has investment in D. B has got a control in C, and B has got a significant influence or a joint control resulting in a JV in D. So you're telling B, by virtue of Ind AS 110, we are giving you a choice not to consolidate. So by virtue of Ind AS 28 as well, you get the same choice. So B will not be required to consolidate C, and B will not be required to consolidate D as well. So if you're telling that B is getting an exemption under Ind AS 110, let's also give him an exemption under 28. So if the entity is a parent that is exempt from preparing consolidated financials, then you also give him the exemption under 28. And these conditions which are given are the same conditions which are given in the para number 4A of Ind AS 110. So the para number 17, if I just want to keep in mind, is simple. If there is a chain, and I say that B by virtue of 110, is getting a exemption under 110, that he is getting a choice not to consolidate. If he's also got an associate, or if he's also got a joint venture, he would be getting exemption under 28 as well. So B will not be required to do a consolidation of C. B will not be required to do a consolidation of D either. That is the para 17. Now let's go further. This was easy. Now let's go further. And you said, so what about dividends? What about dividends? In what connection? Equity method? The concept remains the same. You see, if the dividends are paid, the net asset goes down and the investment also goes down. So trust me, the reconciliation which I gave you, that investment at any given point of time is share in the net assets plus goodwill, always true, whether there is dividends, whatever. Okay, now let's have a look at the para number 18. Very carefully, let's have a look at para number 18. So we've seen one exemption. Let's see the other one. When an investment in an associate or JV is held by or is held indirectly through an entity that is a venture capital organization or a mutual fund, unit trust, and similar entities, blah, 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 the entity may elect to measure that investment at fair value through P&L, that is FPTPL, in accordance with Ind AS 109. Sir, what do you expect, sir, out of us? How much can we absorb in a single go? As I said, don't get worried. What I am discussing in the last 5-10 minutes with you, we will consolidate that learnings in the next class as well. But I want to at least give you the basic framework. So, the model of the story. It says in this case, when an investment in an associate or JV is held by or is indirectly held by through an entity that is venture capital organization. Now let me explain. There is a company A and it has got a significant influence over B. Or there is a company A which has got a control over B and B has got a significant influence over C. Please watch this carefully. We'll be doing some case studies also all on this, but let's watch this. So I'm looking at A is directly having in B significant influence, or A is indirectly having in C significant influence through a subsidiary. So one is direct and one is indirect. Mind it, one is direct and one is indirect. It says when investment in an associate or JV is held by or is held indirectly through an entity that is VCO. If A is a venture capital organization, or in this case, B is a venture capital organization, if the investor is a venture capital organization, that is one, or my subsidiary through which I hold significant influence is a venture capital organization, or it could be a mutual fund or a unit trust, etc. The entity that is A, the entity may elect to measure that investment as FPTPL. So if I am a venture capital organization, or I'm a mutual fund company, or I'm a unit trust, it says very clearly in this case, I may not apply equity method to B. I may not apply equity method to C. I may choose between equity method or FPTPL in accordance with Ind AS 109. The standard is giving me a choice that I can either apply equity method under 28 or FPTPL, whatever I choose. It says you may elect either of them. An entity shall make this selection separately for each associate or joint venture at initial recognition. It says you're going to make this selection, it says for initial recognition for every associate in JV. Moral of the story, if I am a venture capital organization and I get a significant influence directly, I may choose equity method or I may choose FPTPL, Meri Marzi. If I am a venture capital, I'm not a venture capital, but my subsidiary is a venture capital or a mutual fund and they get a significant influence over another company, then in that case also, I get a choice of using equity method or I can choose FPTPL. So now this is getting heavy. Okay, so let me, I think, just quickly consolidate only the basic learning on the exemptions part, and then we can do the discussions more, because para number 19 needs a lot of inputs, because the RTP question which came was basically based on para number 19. So let me just quickly consolidate the learning so far on the exemptions. Let's get this very clear. I'm looking at situation number 1. There is a company A, and company A has got a control over B. The company B has got a control over C. And the company B has got a significant influence over D. Now, let's see the chain. Watch this carefully. So we are saying to this particular aspect, I applied Ind AS 110. To this particular aspect, I applied Ind AS 110. Since it's a chain holding, therefore we can get the choice under Ind AS 110. We applied the 4 parameters, and as per Ind AS 110, we decided he gets a choice. So what I would do in this particular case, I will say you got a choice under Ind AS 110. Let me also give you a choice under Ind AS 28 as well. Let me give you a choice under Ind AS 28 as well. So I will tell B, you don't need to consolidate the subsidiary under 110. You don't need to consolidate D under 28, but A will consolidate B, C, D. But A would consolidate B, C, D. B will be exempted and given a choice of not consolidating C or D, but A will consolidate B, C, and D. Next, let's go to the situation number 2. In situation number 2, I'm going to give you 2 situations. There is a company A. It has got a significant influence. That is situation A. Then I'm taking another situation B. There is a company A which has got in B and it has got in C. In this case, A has got a control over B. And in this case, B has got a significant influence over C. Now watch this. If A is a venture capital or a mutual fund, or maybe unit trust, if A is a venture capital or a mutual fund, in this particular case, I will give A a choice. I will give a choice to A. You want to apply equity method for B? Do it. You want to use FVTPL? Do it. I will tell him you want to consolidate B using equity method? Do it. You want to take it at directly FVTPL? Do it. And if you look at this situation, A is going to consolidate B under 110 and he's going to consolidate C. Now, in this case, B is a venture capital or B is a mutual fund or unit trust. So you hold through a subsidiary which is a venture capital or a mutual fund. In this particular case, again, A gets the same choice for C. So if A himself is a VC or mutual fund, he gets a choice for B. If his subsidiary through which he holds in C is a mutual fund or a venture capital, he gets the same choice for C. So this is what is given in terms of para number 18, and this is what is given in terms of para number 17. But we are not done. We are also supposed to discuss the para number 19, on the basis of which we're going to do the case study with you. So what I'm going to do in the next class with you, I'm going to discuss the remaining aspects, including this aspects of exemptions with you. And we need to discuss that appendix, which is given in Ind AS 28, regarding the long-term interest in terms of the investee. And we also need to do a little discussion on 27. We've got a good agendas in the next class. But next class, we'll be finishing with the consolidations process, the remaining portions of 28, and very slight little things to be done on 27. So we're going to finish that in the next class. I think that seems to be quite good for the day. Let me see if any questions coming on your mind so far. Kriti, you said, sir, FVTPL means Ind AS 109? Yes. We'll be actually getting more hands on, the FVTPL, FVTOCI when we come to financial instruments, and you'll get more clarities at that stage. But, we can't afford to leave this at this stage. Therefore, I'm making a mention. But don't worry, all that will be taken care when we come to the financial instrument standard. Right, friends. So I think over to you for any questions coming to your mind. Otherwise, I think let's call it a day. Heavy day indeed. So do revise all this bit and try the questions, leaving the portions of appendix. I think you should be able to manage at least all the questions on the equity method under 28. Right, friends. I think that seems to be all. No further questions coming in. So I think it's time to, bid goodbye, friends, to you. So we're going to see you in the next class on Tuesday for the last class of consolidation. Thank you very much. The weekend is over. Bye-bye and take care. Thank you.